Well, Mike Hirst, thanks for joining us.
Thank you.
The Big Four are talking about the increased funding costs from the tight credit markets, particularly as a result of Europe. How are you finding the funding markets, the wholesale markets at the moment?
Look, wholesale markets aren't a big concern for us. One of the decisions that we took during the early stages of the GFC, or stage one, whichever way you want to look at it, was to rely only on ourselves to get through. So we wound our business down a little bit during that period. We were the only bank in Australia not to use the government guarantee for wholesale debt, and we're predominantly retail funded. So we're about 80% retail funded, the rest is in securitisation and short-term wholesale. So
that was a good decision, I guess.
I think it was.
Reflecting on it,
yeah,
the way things are going now.
And you know, if you have a look at markets now, I don't think they're at 2008 levels yet. Costs have certainly increased significantly. If you have a look at the recent covered bond issues that have been done, that's certainly priced higher than where I would have expected, and it's pushed out unsecured. So there's no doubt funding costs are increasing. The likely impact for us will be any focus from the majors on deposit markets.
Mike, just assume you're a big bank for the moment and you are borrowing on the wholesale market. Is what you pay in the overseas wholesale market a greater rate of interest than you pay on term deposits? Is the current rate higher overseas than your local term deposits?
By the time you swapped it back into Australian dollars, overseas funding would be higher than term deposits marginally, I think. So term deposits are probably running at about 200 over bills at the moment. Those issues that they've been done overseas are around the 200 to 225 mark over bills.
Okay, so if the wholesale market rates rise further, then it'll be very economic to push your whole deposit rates up to get the money.
Well, only if you can reprice on the asset side. And I guess the thing about funding that maybe a lot of people don't understand is it's the impact it has on the margin, not so much the absolute level of rates themselves. And that's where this whole debate about repricing of home loans and other assets comes into its own.
Mike, you referred to the majors' interest in deposits, and they are no doubt scrambling for deposits to reduce their reliance on the wholesale markets. After February, the deposit guarantee drops from $1 million to $250K, and there's likely to be quite a scramble again to get hold of those big deposits. Is that likely to affect you, because you are almost entirely retail deposit funded?
Yeah, look, I don't think so. The truth of the matter is, when the government guarantee for deposits first came in, it actually impacted upon us negatively. So we were going along quite fine on our own. The guarantee came in. It had a pricing differential depending on what you were rated, and we weren't prepared to pay the cost of the guarantee. So we lost about 800 million in funds from semi-professionals, councils, etc., who wanted the government guarantee but weren't prepared to pay for it themselves. So it was cheaper for them to go to the majors, who only charged them 70 basis points, or Macquarie, who charged them nothing. So no, I don't think it'll have an impact on us at all. In fact, we lost 800 to that sector of the market, but we almost picked exactly that up from the high net worth area of the market, who then looked to spread their funds across different banks.
Were they looking for rates that were higher and were squeezing your margins?
No, I think they were looking to get the government guaranteed. So if you had you were covered for $1 million at any institution, but if you put it through 6 institutions, you got $6 million worth of cover.
If there is competition that pushes the price of deposits up, you operate on lower margins than the majors. How do you respond to that? Is there ability to reprice your lending?
Look, I think there is. I think that is that's going to occur at some stage this year. It has to. You know, in terms of margin, we aren't all that different to the majors. Our margin before we share it with our community bank partners is about the same as what the majors' margin is. So we're under pretty much the same pressure that they might be under. The area where, when you move into a much lower interest rate cycle that we're in now, you actually get pressure also from the low-cost deposits because they can't be moved down at all. So as loans come down, the section that's funded by low-cost deposits or capital gets squeezed. And in this particular market, because of the funding issues, you're also getting squeezed on the other term deposits. So there's no doubt bank margins have fallen, probably 10 basis points in the last 6 months.
Mike, leaving aside the margins and sort of the specifics of what's going on there, what we saw in 2008 was the market changed completely. It previously had been quite competitive, a lot of securitisation, a lot of early, a lot of smaller players, and all of a sudden it went to 90% Big Four, with you and Bank of Queensland sort of trying to hang on and maintain your position. Where do you think the competition is going to come from in the future? I mean, when you look forward 5 years, is it going to stay the same, or will there be some return to securitisation or some other form of competition?
Look, I actually think things are pretty competitive at the moment anyway, and have been for some time. The difference between now and 2008 is that in 2008 there was a lack of funding but plenty of demand for credit. Today there's a lack of funding and not any demand for credit. So the pressures that were perhaps being seen previously in 2008 aren't there. So everyone's competing hard now for growth. So previously where you couldn't compete because you didn't have the funding, and I think Gail Kelly said they grew 10 years worth of growth in 1 year at that point in time. That was because of the funding advantage they had. That's not an issue now because you're competing on the asset side, and that's about service and those sorts of things.
The majors don't seem to be especially interested in balance sheet growth at the moment. What's your positioning?
Well, if you have a look at the last 12 months and growth over the last 12 months, we're second only to the NAB. The NAB's done that on price by their own admission. We haven't. We've done it on service and our value proposition. Our experience has been that over time we do pretty well during tough times because we've got the same value proposition, the same service coming through. It's when the markets are growing, hand over fist, that we probably fall down towards the bottom piece, because in those markets it's all about price.
Mike, bank competition in the future is going to be a lot about systems. The Commonwealth have invested heavily in the front end system. The NAB is investing heavily across the line. I'm not quite sure about Westpac and ANZ. Where do you stand? Are you revamping your entire system, just staying as you are?
Yeah, well, we completed about a $60 million system investment 2 years ago that gives us a one view of customer. So it's a front end system for our customers. Our back end systems are all very good. The bit that counts the interest and who owes what, etc. We can keep that going for a long time, I'm sure. It's the front end, the engagement piece with the customer that's the important piece, and a lot of our system spend goes into that area, and that'll be more important.
Are you as good as the Commonwealth in that area?
Well, I don't bank with the Commonwealth, so I can't tell you completely, but I actually worked with a few of the guys who did some of that stuff at the Commonwealth at State Bank in New South Wales, and from what they've been telling me, they've got a pretty good system.
Does yours match it?
I think it matches it in terms of what our customers are looking for. So it's, I think that in 3 to 5 years' time, I'd like to be in a situation, and maybe that's a bit aggressive, maybe 10 years' time, where a lot of your customer-facing systems are actually operated by the customer.
The community bank model has been very successful. In these times of tighter margins in the total banking area, is it going to be economic? I'm a shareholder in a community bank and it's incredibly profitable. And I think of this enormous money that's coming into this community bank. Can you afford all that in a tighter margin situation?
Look, one of the things that we did with the community bank model when we started it, and that was sort of 13 years ago now, we thought, well, if we get 10 of those, this will be fantastic. Today we've got 270 or 280, but the systems that we put in place 13 years ago were still the systems that were operating up until the GFC, and by and large they did the job. The deal is we get 50% of the margin and the community gets 50% of the margin, and fees etc. get split on a reward for effort basis. But with the change to the term deposit pricing, it did show up a flaw in the systems, and that was because we didn't have a funds transfer pricing system 13 years ago. Fixed rate loans and deposits were done on a trail basis, so we paid 50 basis points for deposits and 50 basis points for loans. When term deposits went from bills less 50 to bills plus 200, the community suffered no margin share and we suffered the complete amount of margin share. So in February, March last year, we went and saw all of our community bank partners, explained the situation to them. The world's changed in terms of pricing for deposits, and we're going to have to move away from a trail on fixed rate to margin share on fixed rate. Now that entails us putting in a funds transfer pricing system, which we've done, so we can count on an individual branch basis, on an individual loan basis, the margin on anything that's fixed rate. We moved from a 50 basis point trail to a 37.5 basis point trail for the next 2-year period, and then at that point in time we'll move to margin share, assuming that the world's in the shape that we expect it should be.
Mike, just to get back to that deposit pricing issue for a moment, all the pressure on the banks, you included, is to raise rates at a time when the RBA appears to be in a downward cycle. If there's another rate reduction, official rate reduction, can Bendigo pass that on?
Well, we need to be competitive. So, you know, it'll be a matter of, well, where are we at that point in time in terms of our competitive position? And right now, I think we're above the NAB, equal with, I think it's CBA and below Westpac and ANZ, or equal with ANZ and below Westpac and CBA.
This is on deposits or loans?
This is on loans. We know that we can probably be about 10 basis points higher than them and still grow our book because of our service proposition and community proposition. So we've got room to move in respect of that pricing. However, we need to take into consideration the impact that it has on our customers and also the impact that it has on our profitability. And all of those things are weighed up at a point in time. Now, one of the things that the industry hasn't been good at is explaining to the public that the official cash rate that gets on the front page of the Herald every Wednesday morning after the Reserve Bank board is met really doesn't have a huge impact on the price of funding that banks pay. And all of the margin squeeze that's going on at the moment is around credit spread, not around official interest rates. And I applaud Mike Smith for the approach he's taking to saying, right, we're just going to set our rates every third Friday or whatever it might be. Mike Smith of ANZ. And, I think that'll go a long way to educating the public about how the price of their loans gets set.
Have you thought about doing that too?
Yeah, well, when we made our last announcement, we said to everybody, look, this really doesn't reflect the cost of funds to us, and it really doesn't reflect how transparent we want to be in our pricing with our customers. And so at some stage we'll be moving away from this approach.
In terms of demand for funds, demand for loans, are you concerned, how are you seeing the retail sector? You lend to a lot, you finance a lot of shops and small retail businesses. How's that faring, and can you see some bad debts there?
We aren't seeing a lot of bad debts come through, and a lot of that business is secured by housing, and so those businesses are very focused on making sure that they're running a tight ship. Now, I'm not for a moment saying that it's not easy, that it's a breeze out there, because it clearly.
So you're saying that the shopkeeper has put his house on the line, or her house on the line? Okay.
And they're working hard to make sure that their businesses are able to work their way through this. And you've seen the increase in the savings rate, just in terms of the amount of term deposits and that have flowed into banks. Equally, the amount of debt that's ahead of its repayment schedule is really significant.
Mm-hmm. What about the actual funding of the shop itself? Because those shops are going to go down in value. Does that worry you?
Commercial property?
Particularly retail shops though.
Yeah, look, we do have a smattering of retail shopping, and yes, the values are being impacted at the moment. I think the question is whether or not people can see the long-term value in those properties and maintain their positions in them. And right now we haven't seen anyone who's not looking to do that. The change in valuations is a bit of a roller coaster over the last few years, to tell you the truth. If you know, online takes hold and retail were to fail dismally, well, clearly there's going to be an issue. Anybody could see that. But you know, listening to one of Alan's shows on an aeroplane one day, they had a guy on talking who made a lot of sense to me, that said those companies that are successful in the digital world are those that have got clicks and bricks strategies, and having either leaves yourself open to issues.
You're fundamentally a mortgage lender, Mike. There's been, as you would be aware, this sort of highly heated and polarised discussion about whether or not the housing market in Australia is a bubble market.
Yeah, it's mainly on your spreadsheets and papers.
You presumably have a view on that?
Yeah, look, the view I hold is that if there is going to be a decline in property prices, it'll be orderly, and it'll, you know, be 2% here, 3% there. And the reason that I hold that is because housing in Australia is majority held by owner-occupiers, and you know, people have to live somewhere. And you know, at the end of the day, well, historically, if property prices begin to fall, people just pull their properties off the market and don't sell. I think it's a great truism that the value of property in Australia is absolutely tied to employment. If people can afford to pay their loans, they will, regardless of, you know, what it's worth, because they've got to live somewhere.
Which of the big four bankers do you admire or fear the most, Mike?
That's an unfair question. Well, actually, I was a bit of a fan of Ralph Norris, and Ralph and I actually went on a course in Seattle in the early 90s when he was MD at ASB, and he was then talking about the systems revolution that you could put through banking, which is what you alluded to earlier, Robert, and I think he's carried that out well at CBA. You know, I know all of them well, and they've all got their strengths, and they're all nice people.
Now, come on, Mike, you have to. Who do you reckon is the top of the tree?
No, I honestly think they've all got their strengths, and if you have a look at the
You're like a good mother, aren't you? You love them all equally.
Yeah, but like any good mother, when I'm alone with each of them, I say they're my favourite. I think the interesting thing about Australian banking at the moment is the strategies that each of the majors have never been so different. So Mike Smith at ANZ is pursuing an Asian strategy, and I think that's a really interesting strategy and probably appropriate for them, although it is a little bit of deja vu if you think back to Grinlays and, you know, those sorts of things. Yeah. Cameron has come into NAB and pursued his breakup campaign, which is, you know, again, an interesting campaign. I think when it all boils down to it, it's a price-led campaign at the moment. Whether or not it can convert into something more than that, only time will tell, but it's certainly a different strategy and well worth a try. CBA very much around customer service, systems development, etc. And I think Westpac are in a situation where they've had a number of reasonable sized mergers, if you think about BT and St George and that over time, and often that does take a bit out of you, but again they seem to be doing a reasonable job.
Is Bank of Melbourne affecting you from Westpac?
We haven't seen that as yet, but
they haven't taken market share from you?
No, but even Bank of Melbourne's rhetoric is that they will take share off the major banks, not the regional banks. Yeah,
I love their ads. You know, if you're sick of the big four, come to us.
I mean, it's an interesting strategy, and I think you know, we'll wait and see how it works. My man in the street litmus test says to me, well, everyone's saying, well, but they're just Westpac, aren't they? So, but you know, I think it's not a strategy that they wouldn't have thought through well. You know, they're very smart people. They would have done all the research. They've been very successful using different brands in South Australia, and I guess the experience with St George is telling them that this will work. So I don't for a moment you know, take it in any offhanded way. It's a serious challenge.
Mike, APRA is moving in terms of Basel III ahead of most of the rest of the world, in particular in relation to the capital requirements. Are you comfortable at the pace at which you're going to be required to hold more capital? Have you got the plans to put that capital in place itself?
I think APRA will tell you that most of the Australian banks, and we did a $150 million capital raising the other day to purchase Bank of Cyprus in Australia, already probably meet the requirements they need to around Basel III. So I'm not concerned about meeting Basel III and complying with it. I think if there is a nagging thought at the back of my mind, it's, well, in the overseas countries, they need to get more credit and better credit into their economies to be able to reinflate them and get them out of the recession they're in. I don't see how putting more capital requirements on banks is actually going to allow that to happen, because credit will become more expensive and there'll be less of it. So there's a real conflict in that between getting the economies up and running and what bank regulators want. And I do, as I said, have a nagging doubt that perhaps in those economies they'll go, well, actually we'll put this aside and we'll do it sometime later when it makes more sense for us. And being an early adopter, you run the risk of being left out there on your own.
You don't see the potential for a weaker version of that same sort of paradigm in Australia as bank capital requirements do raise?
There is no doubt if you require banks to hold more capital, there is less credit and it's more expensive.
It's a particular issue for you, isn't it? If I remember a conversation we had with your predecessor, Rob Hunt, in I think 2009, he talked about the extra capital you have to hold against residential mortgages, because I think at the time you were using a standardised approach to risk weighting, whereas the majors all do self-appraisal and advanced approach. Is that still the case? And how big an issue is that for you going forward?
That is still the case, and we hold about, on average, our housing loans are risk weighted at 40%, the majors are somewhere between 15 and 20. So we're holding twice as much capital against a housing loan as the major banks are. However, under the advanced model, you have to hold capital in a whole lot of other areas where we don't. And so APRA would say that on a like-for-like basis, everybody's probably holding the same amount of capital. We are going to go down the advanced model route, and we're doing that because it gives you new sets of skills and systems, etc., that make your business more robust. So we're doing it from that point of view. If there's capital benefits flow out of that, then great, and I expect there will be.
Well, let's leave it there. Thanks very much, Mike.